Today's topic of management accounting is the techniques of management accounting. And what is management accounting? Management accounting is basically known as the decision making accounting, as the financial statements are analyzed under the management accounting on various parameters. Financial accounting basically tells about the financial position as well as the profitability or loss of the organization. After preparation of financial statements, the next step is to analyze all those prepared financial statements, and their analysis are the part of the management accounting. That's why it is also known as the management decision making accounting. Whereas scholars and authorities have given the definition of management accounting, and the most important definitions of the management accounting are given by the Institute of Chartered Accountants of England and Wales, which shows that any form of accounting which enables a business to be conducted more efficiently can be regarded as management accounting. The management accounting is for the management, for the policymakers to take the decisions regarding the betterment of the organization. Similarly, the Anglo-American Council of Productivity has given the management accounting as it is a presentation of accounting information in such a way as to assist management in the criteria of policy and the day-to-day operation of any undertaking. R.N. Antony has given the definition as management accounting is concerned with the accounting information that is useful to management. And the accounting is information we are getting from the financial statements. And what is the use of those financial statements, those financial informations? The management, for after analyzing all those statements, takes certain decisions for achieving the organizational objectives, that is the maximization of the profitability of that organizations. Various techniques which are used in management accounting to achieve that objectives. For analysis part, there are various parameters, there are factors on the basis of which the analysis takes place, and these are known as the tools and techniques which are used in management accounting. Means how will you analyze the financial statements, and that these are the techniques of management accounting. The first technique is the common size statements. In common size statements, all the financial statements are analyzed on a common parameter. Basically, there is a balance sheet and income statements taking a common base. What are the factors which are been included in those statements should be calculated in terms of percentages. That's why this is known as common size statements. And in case of there are two types of common size statements, just like in common size income statement and common size balance sheet. In common size income statements, the common factor, the common base is the sales turnover, and in context to the sales, all other factors which are included in the income statements are termed in percentages. Similarly, in case of common size balance sheet, total of balance sheet is taken as in base, which is equal to 100. And in context to that 100, that base, all other elements, all other assets and liabilities are calculated in terms of percentages and written in the column of percentage. So that on a single click, single view, you can easily see that what is the percentage of all the elements involved in the income statement as well as in the balance sheet in terms of percentage for taking the decisions. Another is the comparative balance sheet. Here comparative statements. Comparative statements also are of two types, the comparative income statement as well as comparative balance sheet. In comparative income statement, comparative compared to income statements, as well as the balance sheet are prepared to see the changes of the items therein over a period of 2 years, or increase or decrease is calculated in absolute and then in percentages. Means there are two columns in comparative statements. One is the column of absolute change, another is the percentage. Means what is the difference of all those items, that should be written in terms of absolute value as well as in terms of percentages. That is known as the comparative statements. Another technique which is used in the management accounting is the ratio analysis. As we all know that what are the ratio, the ratios are computed on various parameters to check the financial health of the organization, and those parameters are the liquidity, profitability, solvency, and activity. So there are some ideal ratios which has been already given, and after computing the ratios on these four parameters, we will get the liquidity ratios, profitability ratios, activity ratios, and solvency ratios. To study the financial statement seriously and systematically with the help of ratio is known as the ratio analysis. The profitability, financial position, short term and long term, and the pace of business is ascertained with the help of profitability, balance sheet ratios, with the help of turnover ratios, and these are the part of your profitability, solvency, activity, and turnover. Then there is a trend analysis. The possibility of happening or not happening of something in the long run is known as the trend. And to study the same statistically is known as the trend analysis, in which the trend percentages are computed. And those should be plotted in a graph to draw a trend. And on the basis of that trend, the decisions are taken for the future. The trend may be increasing or decreasing, constant or fluctuating. The study of trend helps the management significantly in taking the decisions regarding the business organization. Then there is a cash flow statement, which is going to tell about the cash position of the business. Management wants to know the exact cash position of the business, available cash, whether it is correct or not. For that, there is a cash flow statement analysis, and it is a statement prepared in the end of the financial year to see the changes in the cash position in between two dates, the beginning as well in the end, by taking into consideration operating, financing, and investing activities. For knowing the cash position exactly, all the activities are bifurcated in major three categories, and cash flows from out of these three activities should be computed, and then overall cash flow should be ascertained. And these activities are the financing activities, operating activities, as well as investing activities. Means what is the cash inflow from out of these activities and what is the outflow out of these activities should be computed separately. The net impact is shown as a cash position of the business. The cash which is thought to be the lifeblood of a business organization can be better be managed with the help of cash flow statement. Then there is a fund flow statement. So just like the cash flow statement, fund flow statements are going to tell about the position of the fund, what are the inflows and outflows of the fund, what is the position of funds in the organization. It is a statement to be prepared at the end of the financial year to know the changes in working capital, because in for computing the fund flow statement, fund means working capital. And the working capital are of two types, net working capital as well as the gross working capital. And net working capital is the cash current assets minus current liabilities. The working capital in between two dates should be computed, and what are the changes in the working capital is termed as the funds, and what is the position of the fund in the business is the fund flow statement. It helps in the better management of working capital by observing the usage and application of the fund. Then there is a standard costing. In standard costing, basically the cost is controlled, and it is a cost controlling technique where the standards benchmarks are fixed for various elements of cost, just like material, labor, and expenses. The same are implemented, executed, and the actual performance is measured. And that actual performance is compared with the standard performance. If there is a deviations, if there is a deviation, then whether these are positive or negative means favorable or adverse. If there are adverse deviations, then those should be eliminated or reduced. And that is the purpose of standard costing, to improve the efficiency of the business. Another technique is the budgetary control. It is a cost controlling technique adopted by management accounting, where different business activities are controlled with the help of budgets. Under the technique, the budgets are prepared and implemented for different activities of the organization. Actual performance is compared with the budgeted performance, and the deviations are noted down, which may be favorable or adverse, and consequently, the corrective actions are taken by the management for the better performance.